In roughly 48 hours, on Wednesday afternoon, at exactly 2 o'clock, a single decision will be announced in Washington that reaches directly into the cost of your mortgage, the interest on your savings, the value of your retirement account, and the price of nearly everything you buy. And here is what makes this particular moment different from almost any in recent memory, the thing that has the entire financial world holding its breath in a way it rarely does. Nobody knows what the decision will be. I want you to understand how unusual that is, because normally these moments are theater. Normally, by the time the Federal Reserve announces what it is doing with interest rates, everyone already knows the answer. The drama is gone, the markets moved weeks ago, and the announcement itself is a formality. But not this time. This time, the professionals, the banks, the traders who do nothing all day but predict exactly this, are split almost down the middle. The market is pricing roughly a 1 in 3 chance that the Federal Reserve raises interest rates on Wednesday, and a 2 in 3 chance that it holds them steady, which in the language of finance is not a forecast at all, it is a coin toss with a thumb on the scale. One of the largest banks in the world says a surprise rate increase would not surprise it at all. Another major bank says raising rates now would be unjustified. They are looking at the same economy, the same data, the same central bank, and they cannot agree on what happens in 48 hours. And the reason they cannot agree comes down to one man, a new man, a man who has deliberately made himself impossible to read, and who has said something about inflation that no Federal Reserve chairman has said this bluntly in years. His name is Kevin Warsh. He is the new chairman of the Federal Reserve, and in the next 20 minutes I am going to show you why his arrival has turned a routine announcement into the most genuinely unpredictable financial moment in years, what the two possible outcomes would each mean for the money in your pocket, and the single strange thing he has done that has stripped away the safety net the markets have relied on for decades. And I am going to take you back to a single year 1994, because the last time the Federal Reserve genuinely surprised the markets, the damage was so enormous and so swift that it has its own name in financial history, and the people who were not ready for it were destroyed in a matter of months. Stay with me, because this is not a distant story about bankers in a room. In 48 hours it becomes your story, whether you are watching or not. Let me start with the most basic and most important thing, which is what this decision actually is, and why a single number chosen by a committee in Washington controls so much of your life. The Federal Reserve sets what is called the interest rate, and specifically it sets the one rate from which nearly all other rates in the economy flow, the rate at which the whole financial system borrows at its foundation. Think of it as the price of money itself. When the Federal Reserve raises that rate, money becomes more expensive throughout the entire economy. Your mortgage costs more. Your car loan costs more. The interest on your credit cards climbs. Businesses borrow less and expand less. And, crucially, the savings in your bank account and the bonds in your retirement fund are all repriced, because when the foundation rate moves, everything built on top of it moves too. When the Federal Reserve lowers that rate, the opposite happens. Money becomes cheap, borrowing becomes easy, and the economy is flooded with cheaper credit. So this one decision, made 8 times a year by a small committee, is arguably the single most powerful lever in the entire economy, more powerful in its daily effect on your life than almost anything any president or parliament does. And for the last several meetings, that lever has been held completely still. The rate has been kept at a range of 3.5 to 3.75%, unchanged, meeting after meeting, as the Federal Reserve tried to hold a difficult line. But now the pressure on that lever is building from 2 directions at once, and that is why Wednesday is different. Here is the pressure, and understanding it is the key to understanding the coin toss. On one side, there is inflation, the rising cost of everything, and it has proven far more stubborn than anyone hoped. The war in the Middle East has pushed the price of oil sharply higher, at times above $100 a barrel, and because oil is the cost of moving and making almost everything, high oil prices push up the price of nearly all goods. Inflation has been running well above the level the Federal Reserve considers healthy, stuck stubbornly high, And the entire job of the Federal Reserve, its single most important duty, is to bring inflation down. And there is only one tool to do that: raise interest rates, make money expensive, cool the economy, force prices back into line. So that pressure pushes toward a rate increase on Wednesday. But on the other side, there is the fear of doing damage. Raising interest rates to fight inflation also slows the economy, and slow it too much, and you cause a recession, throwing people out of work, crushing businesses, doing enormous harm. And there are signs that the economy is already cooling, that the pressure of high rates is already being felt. So that fear pushes toward holding rates steady, toward patience, toward waiting to see whether inflation cools on its own before risking real damage. Inflation says raise, caution says wait, and the Federal Reserve is caught precisely between them, which is why this is a genuine coin toss, and why the smartest analysts in the world genuinely disagree. But there is a third factor, and it is the one that has made this particular meeting so uniquely unreadable, and it is entirely about the new man in charge. For years, the Federal Reserve operated on a principle it called forward guidance. The idea was simple. The central bank believed that surprising the markets was dangerous, that sudden unexpected moves caused panic and chaos, and so it went to great lengths to telegraph its intentions in advance. Before every decision, officials would give speeches, drop hints, signal their thinking, so that by the time the actual announcement came, the markets had already adjusted and there were no nasty surprises. It was a policy of no shocks, a deliberate smoothing of the path, and the markets came to rely on it completely, like a safety net always stretched beneath them. And then Kevin Warsh became chairman, and he tore that net away. Warsh has deliberately, openly moved the Federal Reserve away from forward guidance. He has criticized the old approach as too much hand-holding, too much coddling of markets that he believes should stand on their own. He gives shorter press conferences. He declined even to submit his own economic projections at his first meeting, the little dots on a chart that used to tell the world where each official thought rates were heading. He has, in short, deliberately made the Federal Reserve harder to read, and he has done it on purpose, because he believes a central bank that keeps the markets slightly uncertain, slightly on their toes, is a more effective and more disciplined one. Which means that this Wednesday, for the first time in years, the markets are flying without the safety net. There has been no clear signal. There has been no telegraphed intention. And the statement the Federal Reserve will release, which used to be a lengthy document full of guidance, is now expected to be barely 130 words, a tiny terse announcement that traders will scour syllable by syllable for any hint of what comes next. When a document that short carries that much weight, every single word becomes a landmine. That is why this meeting matters so mucho more than its routine appearance suggests. The man in charge has deliberately removed the one thing that made these moments predictable, and he has done it precisely because he wants the markets to take inflation, and him, seriously. And there is one more thing about Warsh that you must understand, because it may be the most important clue of all, and it is something he said out loud, to Congress, in plain language. He said that the Federal Reserve has, in his words, no tolerance for persistently elevated inflation. No tolerance. And he criticized the Federal Reserve, his own institution, for having let inflation run above its target for 5 years. Think about what that tells you. This is a chairman who came into the job believing his predecessors were too soft on inflation, too willing to let it run, too eager to protect the markets and the economy from the pain of the cure. He has staked his reputation, his entire credibility, on being the man who finally gets tough, and a man who has staked his credibility on being tough on inflation, facing a moment when inflation is stubbornly high and oil is surging, has a powerful personal and institutional reason to act, to prove that his tough words are more than words. That is the case for a surprise rate hike on Wednesday, and it is why one of the world's largest banks says it would not be surprised at all. On the other hand, the most recent inflation data actually came in softer than expected, and there is a strong argument that raising rates merely to prove a point, when the data is finally cooperating, would be reckless. That is the case for holding, and it is why another major bank calls a hike unjustified. Both arguments are strong, both are held by serious people, And the only person who truly knows the answer is a man who has made a deliberate policy of not telling you. That is the coin toss. Now let me show you what each side of that coin means for you. If the Federal Reserve holds rates steady on Wednesday, which remains the more likely outcome, the immediate reaction will probably be relief. Markets tend to like it when rates are not raised because cheap money supports stock prices, so stocks may rise, and the pressure on borrowing costs eases for the moment. But, and this is the crucial part that most people miss, holding on Wednesday would not mean the danger has passed. Because the same analysts who see a coin toss for Wednesday see something very different for September. The probability of a rate increase at the following meeting in September is priced not at 1 in 3, but at around 80%. 80%. So even if Warsh holds this week, the market broadly expects him to raise rates before the year is out, likely twice. Which means that if he holds on Wednesday, the truly important thing will not be the decision itself, but the tone. The markets will be searching that 130-word statement and his brief press conference for any hint of whether the September hike is coming and how hard. A hold with a gentle tone is one world. A hold with a stern warning is a completely different one. And if, on the other hand, the Federal Reserve surprises everyone and raises rates on Wednesday, the reaction could be sharp and immediate. A surprise hike would tell the world that Warsh is even more serious about inflation than feared, that the era of cheap money is ending faster than expected. Borrowing costs across the economy would jump. The value of bonds, which falls when rates rise, would drop, hitting the bond portion of retirement accounts. Stocks, which have grown accustomed to the expectation of eventual rate cuts, could fall as that hope is stripped away. A surprise hike is the outcome the markets are least prepared for, and the things markets are least prepared for are always the things that cause the most sudden damage. Which is exactly why I want to tell you the story of 1994, because it is the story of what happens when the Federal Reserve does the thing the markets did not see coming. The year is 1994, and to understand it, you have to picture the world just before it. For several years, interest rates had been low and stable. The markets had grown comfortable, even complacent. Investors had built enormous positions on the assumption that rates would stay low, borrowing cheaply to buy assets, confident that the calm would continue, because it always had. And then, in February of 1994, the Federal Reserve, under its chairman Alan Greenspan, began to raise interest rates, and it did so in a way the markets had not fully anticipated. It was not a catastrophe of a hike, it was modest at first. But it was a surprise, and it signaled more to come, and it shattered the comfortable assumption on which so many had built so much. What followed is remembered in financial history as the Great Bond Massacre. As rates rose through that year, the value of bonds collapsed because bond prices fall when rates rise, and the fall was brutal and swift. Investors who had borrowed money to bet on stable rates were wiped out as the ground shifted beneath them. An estimated $1.5 trillion of wealth was destroyed in global bond markets in a matter of months. A county in California, Orange County, one of the wealthiest in America, had made exactly these bets with public money, and it went bankrupt, one of the largest municipal bankruptcies in American history, because it had been so certain rates would not move against it. And here is the lesson, the one that echoes directly into this Wednesday. The damage in 1994 was not caused by rates being high. Rates were still, by historical standards, quite moderate. The damage was caused by the surprise, by the market being positioned for one thing and getting another. It was the unexpectedness itself that did the harm, because when everyone is leaning the same way and the floor shifts, everyone falls at once. The people who survived 1994 were not the ones who predicted the hikes, because almost nobody did. The people who survived were the ones who had not bet everything on the assumption that the calm would last forever, the ones who had left themselves room to be wrong. So let me draw the line from 1994 to this Wednesday, because the parallel is not exact, but the lesson is precise. Then as now, the markets had grown comfortable with an assumption about rates. Then as now, a Federal Reserve determined to fight inflation was prepared to act in ways the markets were not fully braced for. And then, the surprise itself, the gap between what was expected and what happened, was where all the damage lived. I am not predicting a repeat of 1994 this Wednesday. The situations differ in important ways, and a single meeting rarely triggers a full-blown massacre. But I am telling you that we are in one of those rare moments when the outcome is genuinely uncertain, when a new and deliberately unpredictable chairman, who has staked his reputation on fighting inflation, holds a decision that the smartest analysts in the world cannot call, and that whatever he decides, the markets are by definition not fully prepared for one of the two outcomes. And moments of genuine uncertainty, moments when the safety net of forward guidance has been deliberately removed, are exactly the moments when the unexpected does the most harm to the people who assumed nothing would change. So let me bring this home to your kitchen table, the way I always do. Because this is not really about Kevin Warsh, or 130 words, or a committee in Washington. It is about you, and about how you should think in a moment of genuine uncertainty rather than false confidence. Here is the single most important thing I can tell you. When the outcome is a genuine coin toss, when even the largest banks in the world cannot agree, the correct response is not to guess. It is not to bet everything on one outcome, because you have no edge. None of us do. That is what a coin toss means. The correct response is to make sure you are not dangerously exposed to either outcome. And that leads to one calm, free, no-pressure question you can ask yourself before Wednesday afternoon. If interest rates were to rise suddenly and more than expected, how much would it hurt me? Do I have debt that would become more expensive? Debt at a variable rate that climbs when the Federal Reserve climbs? Is a large part of my retirement in the kind of long-term bonds that fall hardest when rates rise, the very thing that was massacred in 1994? Am I leaning, without ever having chosen to, entirely one way, so that a single surprise on Wednesday could do me real harm? You do not need to predict the decision. Nobody can, and anyone who tells you they know for certain what Warsh will do is either fooling themselves or trying to sell you something, and you should keep your hand on your wallet. You simply need to know your own exposure, so that whichever way the coin lands, you are not the one caught leaning the wrong way when the floor shifts. That is not fear. That is preparation. And preparation is the calm cousin of fear, the one that protects you instead of paralyzing you. And if this awareness ever leads you toward a real change in how your wealth is arranged, make it the way I always counsel, slowly, over unhurried thought, with a professional legally bound to act in your interest, and never in a panic in the 48 hours before a Fed meeting, because rushed decisions made in the shadow of a deadline are the most expensive decisions of all. So let me close the loop I opened. In roughly 48 hours, a single man will make a decision that reprices your mortgage, your savings, your retirement, and the cost of nearly everything you own, and for the first time in years, nobody, not the banks, not the traders, not the analysts who do nothing else, can tell you what that decision will be. It is a genuine coin toss, because a new chairman, Kevin Warsh, has deliberately torn away the forward guidance that used to make these moments predictable, has declared that he has no tolerance for the inflation his predecessors allowed to run for 5 years, and has staked his entire credibility on being the man who finally gets tough, which gives him every reason to surprise the markets, even as the softening data gives him every reason to wait. Whatever he decides, it will be compressed into a statement of barely 130 words that the world will read like scripture, and one of the two possible outcomes is one, the markets are not braced for. The last time the Federal Reserve genuinely surprised the world, in 1994, it destroyed $1.5 trillion of wealth and bankrupted one of the richest counties in America, not because rates went high, but because the surprise itself caught everyone leaning the wrong way. I cannot tell you what happens on Wednesday, and I would never insult you by pretending to, because the entire point of this briefing is that nobody can. But I can tell you that the wise response to genuine uncertainty is never to guess, but to know your own exposure, so that you are protected whichever way the coin falls. If this briefing helped you understand why the whole financial world is holding its breath over a decision most people do not even know is coming, take a moment to share it with one person you care about who has a mortgage, a pension, or savings, which is to say, everyone. And I would truly love to hear from those of you who remember. If you lived the rough 1994, or any moment when the Federal Reserve moved and caught the world off guard, tell the younger people watching what it felt like and what it taught you. because there is someone reading this whose entire financial life has unfolded in an era of predictable central banks and telegraphed decisions, who has never once experienced a genuine surprise from Washington, and your memory is the only teacher that can prepare them before Wednesday arrives. I read every single comment. I will be watching the decision when it lands, and I will see you, as always, in the next briefing.